Welcome to Principles of Accounting 1. This is a little overview of Chapter 1. Will supplement your reading of Chapter 1. But in general, the purpose of accounting is to identify, record, and communicate the economic events of an organization to interested users. And economic events here is kind of a key phrase. We're going to distinguish as we go along economic events from political events or social events or God-made catastrophes kinds of things. But keep in mind they're economic. Three activities in accounting. First one starts out with identifying a transaction. And as I said earlier, determining whether or not we need to record it. And then analyzing what the impacts are on the business. Then we move from identification into recording, and where we're going to record it, then we classify and summarize it. And to classify and summarize things are key. You can imagine all the millions of transactions every day that a Walgreens or a Walmart has, and there needs to be a way to summarize that data and make it usable for people who are interested in knowing the results. And the communication piece there is preparing the accounting reports. We've analyzed the transaction, we've recorded it, now we need to generate accounting reports that we can give to users, and we may need to do some interpretation and analysis for the users. The blue circles here represent internal users, internal to a company, so that management, HR, finance, marketing all have need for accounting data. And then there's a whole host of outside users who need information. IRS needs it for taxation purposes. Investors need it. They want to know whether to increase their investment, whether they should loan the business some money or not loan the business some money. Labor unions, creditors, SEC. SEC is short for Securities Exchange Commission, as well as customers, all external, all need to know how the business is doing. Common questions asked, and this indicates who the users are. So the second question, for example, did the company earn a satisfactory income? Clearly investors would want to know that. Customers might want to know that. We have ethics in financial accounting. We've always had ethics, always been important. The last decade or so we've probably had more scandals, certainly more visible public scandals than we had previously. Enron, WorldCom, HealthSouth, AIG, and a bunch of others. And Congress had to react, and they passed the Sarbanes-Oxley Act. We'll see how effective that is. It's hard to legislate ethical behavior. Review question for us. Ethics are the standards of conduct by which one's actions are judged as right or wrong, honest or dishonest, fair or not fair, or D, all of the above. I'll vote for D, all of the above. So we have different users out there, internal, external, and they need different kinds of accounting data. And our accounting data here, our financial reports, these items listed in the upper right-hand corner. And the accounting world has come up with some generally accepted accounting principles. Pronounce that GAAP. And GAAP has been developed over a period of time. It can be influenced by financial accounting standard boards and other regulators. Congress can influence it. But it is the general body of knowledge and general body of concepts that accountants use on a daily basis. SEC is involved in influencing accounting principles, the Financial Accounting Standards Board, the International Accounting Standards Board, and probably this international one has gotten a lot more important in the last 10 or 20 years as almost all of the big companies have become global competitors. It's not just they're not just players in the U.S. They compete around the world. One of the real fundamental general accepted accounting principles is the cost principle. And the cost principle says that we record assets. When we buy something, we record it on our balance sheet at its cost, and we don't change it. Just because the price has fluctuated, we're going to keep it on our balance sheet at what we paid for it. It's easy to verify. Market value is subjective and can be manipulated. And imagine companies who bought land back in the 1920s or 30s, and they still have it on their balance sheet. Obviously, it's gone up in value, but the accounting world has decided that it's better, less subject to manipulation, to leave things on the books at what they were paid for. There's a monetary unit assumption. We're only going to record items that can be recorded in terms of money. And we may have some other things that take place, and we might want to try and estimate what they're worth, but if we can't apply a financial dollar thing to it, then there's no way to record it. And then the economic entity assumption. And this is really an issue with small businesses. Say that I own a auto body repair shop. That's a sole proprietorship. I own it. Lots of times people will run a checkbook and they'll write both personal expenses out of that checkbook and business expenses. And the economic entity assumption says that we just want to do the accounting for the business. So we're just interested in the things that relate to my auto body shop, not the other things. So we need to pull those out. We'll break out here proprietorships, partnerships, and then finally corporations. But a lot of businesses are proprietorships, could be sole proprietorships. They tend to be small, and the owner is responsible for everything. Then you have partnerships, and we don't see many partnerships. I mean, there are some, but not many. I always tell people going into partnership with somebody is a good way to lose a good friend. And finally, we have corporations, and those are legal entities set up by states, and corporations actually become people. They have the same rights under the law that people have. Well, quick review question here. If we combine the activities of Kellogg and General Mills, we would violate which principle? And the answer is B, the economic entity assumption, because those two entities are separate. They haven't merged. Another review question. Business organized as a separate legal entity under state law having ownership divided in shares and stock is a corporation. Proprietorships and partnerships and sole proprietorships don't have stock. It's only corporations that do. Here is the basic accounting equation, absolutely critical. You're going to use this in every chapter. It's the underlying framework. But assets equal liabilities plus owner's equity. Assets can be claimed by either creditors or owners, and creditors get paid before owners get paid. But A equals L plus OE. I call it the 11th commandment. And when you break the 11th commandment in some of your homework, I will tell you that you broke the 11th commandment, and that the 11th commandment in accounting is every bit as important as the first 10 commandments. Assets. Assets are things that a business owns. It can be tangible or intangible. Tangible are the things you can kick, like supplies, like a building, like inventory. Intangible things are things like patents and copyrights, trademarks, that you really can't kick those. They're more of a intellectual property item. Liabilities are claims against the assets, and it's money to who. Those are people that we owe money to, we owe something to, creditors. Typically things like accounts payable, notes payable, could be taxes payable or wages payable, but has a payable in it, It's a liability. It's something that the business owes. And then what's left over really is the owner's equity. What the owner has invested in the business, what the owner's balance is after a whole host of transactions have taken place. Capital drawings are all part of owner's equity. So here's a variation of the equation. So earlier it was assets equals liabilities plus owner's equity. Here it's assets minus liabilities equals owner's equity. So we've manipulated that equation a little bit. Here's another variation. Assets minus owner's equity equals liabilities. So again, another manipulation. You'll get to use all of these as we go along in accounting. It's helpful to solve different kinds of accounting issues or different homework problems. And then here we expand our equation a little bit. So assets equal liabilities plus owner's equity. And then on the owner's equity side, we have capital minus owner's drawing. That would be things that the owner takes out of the business, plus revenues that the business has earned, and the minus expenses of the business. Expenses are the cost of producing the revenue. Got common expenses here: salaries, rent, utilities, tax, advertising, so on. Okay, so transactions are recorded, are business economic events recorded by accountants. They may be internal or external. Not all activities represent transactions. Each transaction has a dual effect on the accounting equation. Lots of political things or social things might impact a business, but if there's no event, it doesn't get recorded. I use the example of a business located in a very nice neighborhood, a very nice strip mall, and all of a sudden the mall starts to fail. Perhaps you bought a store in the strip mall, and you paid $1 million for it, and the businesses around you start to fail. Arguably your building now is worth less than $1 million, but there's been no economic event that would let you reduce the cost of that building. Likewise, or similar contrast to that, let's say you buy $1 million building in a mall, and then the mall really takes off, and so the building's worth more than $1 million because everybody wants to be in this mall. There's no economic event that would trigger you to write up the cost of that. So we're going to keep it at that historical cost. So question here: the following events recorded. First event: supplies are purchased on account, and an employee is hired, and the owner withdraws cash for personal use. The criterion: did the financial position of the company change? And supplies are purchased on account. Things did change. We now have supplies. We now owe money. But when an employee is hired, there is no economic event. There might be an economic event in the future as they work for us, but the simple act of hiring them doesn't create an event. Once they work for us, generate some revenue for us, then we will be responsible for their payroll. And the owner withdraws cash for personal use from business. That obviously impacts both an asset and the owner's equity, so that would get recorded. Discussion item: in February 2010, Paula King invested an additional $10,000 in her business, King's Pharmacy, which is organized as proprietorship. Her accountant recorded this receipt as an increase in cash and revenues. Is this treatment appropriate? Why or why not? No, it would not be. Revenues involve transactions with outsiders. So when an owner contributes additional capital to the business, it's not revenue. It will increase owner's equity, but it's not a revenue item. So we're going to run through some transactions here. Transaction 1, Ray Neal wants to open a computer programming business. He calls it SoftBite. He invests $15,000 cash in the business. So we increase cash by 15 and we increase owner's equity by 15. No liabilities yet, but our accounting equation is still in balance. Assets equals liabilities plus owner's equity. The second transaction, they purchased some computer equipment. They cash for it. So we decrease cash by 7,000 and we increase an asset account called equipment by 7,000. So our assets equal 15,000. There's no liabilities. Owner's equity is still 15. So our accounting equation, bless us, is still in balance. Third item, we purchased supplies from Acme for $1,600 and we did it on account. So we increased the supply account and we increased our accounts payable. Now, accounts payable is a liability, but our assets now total 16.6 and our liabilities, owner's equities, total 16.6, so our equation's still in balance. Interesting that in this problem they tell us that the supplies are expected to last several months. If the supplies were just going to be real short term, like a day or two, we might have put them right in expense. But because we're going to use these supplies over a period of several months, we set them up as an asset, and we'll gradually, as we use them, reduce our asset account supplies and increase our expense account. Probably call it supply expense. Transaction 4, we did some services for customers. They paid us $1,200 cash, so we increased cash by $1,200 and we increased revenues by $1,200. And revenues is part of that owner's equity on our A equals L plus OE formula. Transaction 5, we bought some advertising from our newspaper. We haven't paid for it yet, so we increased accounts payable by $250 because we owe more money, and we increased expenses by $250. And this shows up as a minus $250. It's a minus from owner's equity, but it's an increase in expenses. That'll get clearer later on, I hope. Transaction 6, we earned some more revenue. We did some more work with $3,500 of programming services, so we increased our revenue by $3,500. One customer paid us cash for $1,500, and we have another customer or multiple customers that owe us a total of $2,000. So we increased our cash balance by $15,000, increased our accounts receivable by $2,000. Once again, our assets total $21,300, and that equals our liabilities plus owner's equity, so our equation's still in balance. Don't we love it? Transaction 7, they paid cash for some expenses, store rent, salaries, and utilities. Again, things stay in balance. Transaction 8, we actually paid for the advertising bill. You remember earlier we put an amount in accounts payable and we increased our expense. Now we're going to pay that bill. We pay it with cash, so we decrease our cash by $250 and we decrease our accounts payable by $250. We now owe $250 less than we did. Transaction 9, we received $600 in cash from a customer we'd previously billed. When we billed them earlier, remember we put it in accounts receivable and in revenue. Now we're going to take it out of accounts receivable because they paid us, and they paid us in cash. So we're going to increase cash and decrease accounts receivable. And transaction 10, Ray Neal took out $1,300 in cash from the business for his personal use. So we decrease cash by $1,300 and we decrease owner's equity by $1,300, which is actually an increase to a drawing account. So here's a summary of transactions, and if you look at the bottom there, you can see that assets total $18,050 and our liabilities, owner's equities, totals $18,050. So our accounting equation is in balance. We haven't broken the 11th commandment. I'm ecstatic. Once we've analyzed these transactions and recorded them, then we're going to start generating financial reports. We have 4 common financial reports: our income statement, our owner's equity statement, talks about what happened in that area during the period, our balance sheet, which is a snapshot on a particular point in time, and followed by a statement of cash flows. Quick question here. Net income will result during a time period when assets exceed liabilities. That's not the case. Assets exceed revenues. That's not the case. Expenses exceed revenues. If that's the case, we got a net loss. So I'm going to go with answer D here. Revenues exceed expenses. We've generated more revenue than we had expenses. That gives us net income. So here's our income statement for the month. And do notice that this is for the month ended September 30th. Income statements, owner's equity statements, cash flow statements are always for a time period, where a balance sheet is for a specific point in time. So our revenue was $4,700 per month. We had expenses of $1,950. We wound up with net income of $2,750. That net income flows into our owner's equity statement. We had the owner put in $15,000 to start the business with. We had net income of $2,750. He had drawings of $1,300, so he took that $1,300 out of the business, which leaves us an ending balance in our capital account of $16,450. Just another recap of that. Then the bottom part here is the balance sheet of September 30th, and the balance sheet is at one point in time. Think of it as a snapshot of where the business is as of this precise second. So in cash, we have $8,050, accounts receivable, supplies, equipment, for a total of $18,050, and then our liabilities, owner's equity, accounts payable $1,600, and the owner's equity that we got off the previous statement, $16,450. So a bigger blown up picture of our balance sheet. And then we generate, as we see on the bottom part here, a statement of cash flows. And statement of cash flows is really vital. It's not uncommon, unfortunately, for businesses to be profitable, but they don't have cash on hand. And if they don't have cash on hand, they can't pay employees, they can't pay suppliers, and people get very cranky. So it's not enough just to be profitable. You actually have to have cash available to take care of your debts. So here's a sample cash flow statement. We had from revenues, cash receipts of $3,300. We had expenses outgoing in $1,950. So our net cash provided from operating was $1,350. We purchased equipment that used $7,000 in cash, but we had a net difference of $13,700 that the owner contributed. So it leaves us with, we started the month, obviously we're new business, with no cash, and we ended the month with $8,050 in cash. So review question: which of the following financial statements is prepared as of a specific date? That would be the balance sheet. Remember, it's always a snapshot of a point in time. Another discussion item. Company's net income appears directly on the income statement, owner's equity statement, and it is included indirectly in the company's balance sheet. Do you agree? Well, yes, we do agree with that. The owner's equity is part of the asset basic accounting equation, so of course it's included in the balance sheet. Different career opportunities. I won't spend a lot of time on this, but there's public opportunities in public accounting. People go on to become CPAs or certified professional accountants. There's a whole host of private accountants, work for different manufacturing, different service businesses. There's opportunities in government. The IRS is always looking for agents, the FBI, the SEC. And then kind of a new field is forensics accounting. And as we try and trace dollars involving fraud and terrorism and those kinds of activities, we need more and more forensics accountants.